Okay, let's do money in banking. This is a very huge chapter. Let's start. So, how is money created through fractional reserve banking? Let's say if he has 100 rupees, he gives us 100 rupees to banks, he deposits there. Bank will keep 10 rupees as reserve requirement and gives 100 rupees, 90 rupees as loan to B. So, B will spend this and somehow or the other, all the money comes back into bank. And again, they will keep 9 rupees as the reserve requirement and loans 81 rupees to C. So that way total money, only 100 rupees was deposited, but the money created will be 90 plus 81 plus so on. If we add all those, we'll get 100 by point 1, that is 1000 rupees. So for 100 rupees, 1000 rupees was created. Therefore money multiplier would be 1 divided by reserve requirement. In this case money multiplier is 10, and the money created would be new deposit into money multiplier, that is 100 into 10,000. So this way banks create money. This is one of the most important ways of money creation. Now coming to definition of money, this is only from Prelims point of view. It is any generally accepted medium of exchange, thus eliminating double coincidence of wants in the barter, that is giving wheat for sugarcane. Both should have the same needs. Now coming to money, it should be readily acceptable, it has known value, it should be easily divisible, it has a very high value compared to its weight, and it should be difficult to counterfeit. Now, what are the functions of money? It is a medium of exchange, therefore solves the double coincidence of wants problem. It is a unit of account, therefore it can measure the value of goods and services. It is a store of value, therefore your purchasing power can be stored. For example, if you are trading with wheat, your wheat will go bad, so you have to purchase immediately. Now coming to, it is a standard of deferred payment, so therefore you can take loans easily. It is a distributor of national income, example salary and pension. Now coming to kinds of money, there are currency and deposit money. The currency is fiat money, that is on the order of the government, and it is legal tender, that is you cannot reject payment in currency. And deposit money, there are demand deposit and time deposit. This is like FD, this is like your savings bank account. And now measures of money, this is again from prelims point of view. We have M1, M2, M3 and M4. These two are narrow money, these two are broad money. Going from here to here, liquidity will decrease. M1 is your currency and net demand deposits. Net here means that only include deposits of public LP bank, not interbank deposits, then it will be like double counting, so don't include this. And coming to M2, we have all this M1 plus post office saving deposits, not important for mains. And M3 we have M1 plus net time deposits. So this will be broad money. And M4 is M1 plus total post office deposits. So these two are the broad money. The most common measure of money supply is this one, M3. So currency plus net time and demand deposits. Now coming to high powered money, that is the monetary base. This is the total liability of RBI in terms of currency and deposits held with the RBI. Both government and scheduled banks hold the deposit with the RBI. This is called as a high powered money. And factors affecting money supply are currency deposit ratio. This depends on the people preference for liquidity, therefore it is a behavioral pattern. Example, during Diwali, people will withdraw the money to be more liquid. And a reserve deposit ratio, which are CRR and SLR, that is cash reserve ratio and statutory liquidity requirements. So these two will different affect the money supply. Now coming to types of banks, we have three functions of the banks, which are taking deposits, lending and creating money. Indian banking system has regional rural banks, cooperative banks and commercial banks. Now first we will do regional rural banks. It has the objective of creating credit facilities for rural and weaker sections. This was created in 1970. Some of the examples, give your local RRBs. We have Assam and Allahabad one. And PSB as a sponsor bank, will see what it is. So they have to subscribe to a share capital. They have to train the personnel. They have to give managerial and financial assistance. In 1997, they were free to lend outside target group, that is agriculture and weaker. Now merging of RBI RRBs is going on. So the PSL target, that is priority sector lending target, is up to 75%. Now coming to capital, government will, India will invest 50%, states will invest 15%, and sponsor bank, that is this one, will invest 35%. Now cooperative banks, this on the basis of cooperative principles to deal with ordinary banking. So these are established by state laws, regulated by RBI and registered under Cooperative Societies Act 1912. So the aim is to fund agriculture and allied sectors and village and cottage industries. So they both take deposits and also lend. They operate on a no profit no loss motive, and the decision making is made by one person one vote formula, and NABARD is the apex body for them. Now types of cooperative banks, you have urban and rural. In rural we have short term and long term. Short term are PACs or primary agriculture trade societies. We have DCBs at district level, and SCBA, which are the apex body for the cooperative banks at the state level. Now long term we have primary, these are called CABRD, and they are state CABRD. We'll see what they are. So coming to NABARD, their target is to facilitate credit flow for agriculture, small scale industry, cottage and mill industry, and they act as regulator for RRBs and cooperative banks. They coordinate for rural credit with RBI, government, and RRB and cooperative banks. They also provide training and research facilities. Now coming to urban cooperative banks, they refer to the primary cooperative banks in urban and semi-urban area. They lend money only to non-agriculture, but it does not hold true. They are even linked to agriculture these days. Now challenges are limited ability to mobilize resources because of competition with regular banking, and restrictions with respect to investing surplus. There are restrictions where they can invest their money, low recovery level of loads, high transaction cost, rising competition, and autonomy is questioned because government officials are deputed in these boards. Now, R. Gandhi committee gave some recommendations with respect to UCBs, which are if the business size of UCBs is greater than 20,000 crores, converted into small finance bank, less than 20,000 crores, converted into small finance bank. If it's greater than 20,000 crores, converted into commercial bank. When giving to fresh license credit, only consider cooperative credit societies which are financially sound, well managed, and has a minimum track record of 5 years. Also, the board of management should be separate from board of directors. This is also set by Malegam committee, and depositors should be the voting members. Majority of the board seats should be reserved from them. Now, should large UCBs should be converted into commercial banks. Some of the UCBs, they are small, greater in size than small commercial banks, and also they have a huge geographical spread. Therefore, cohesion becomes difficult for these banks. So, according to R. Gandhi committee recommendation, we should convert them into commercial banks. Coming to rural cooperative banks, we have short-term structures which are SCB, DCB, and PAC. So, SCB is a apex body for cooperative banks at state, so they coordinate with RBI and NABARD, and they don't give loans to individuals. They give only loans to DCB and PAC. DCB, they give loans to PACs and also to individuals. PAC gives loans to only individuals. Now coming to long-term structures, we have state and primary CABARDs. So they give loans for 1.5 to 25 years. They mainly give loans for land development, agricultural equipment, etc. Now coming to commercial banks, their motive is profit, and they are regulated under Banking Regulation Act 1949. So their types are public sector and private sector. Public, we have State Bank Group and other nationalized. Private sector, we have Indian banks and foreign banks. Now coming to public sector banks, these are banks where government has majority ownership, that is more than 51% shareholding. So firstly, we have a State Bank Group which is being consolidated. Why consolidation? To increase the market share. After consolidation, market share increased to 22% from 17%. For economics of scale, for better liquidity management, for technological know-how, for quality products, for professional standards, for international recognition, and better customer service. So in nationalization, it happened in two phases, in 1969 and 1980. Why in 1980? Because agriculture was given only 2% credit. It was branches were more concentrated in urban areas. They were catering only to rich. Monopolistic trends were being seen, and concentration of economic power. So according to DPSP, they nationalized these banks. And what are the objectives of nationalization? Is to mobilize savings, banking operations to be guided by social purpose, and ensure legitimate credit needs are met rather than catering only to rich, and cater to agriculture, small scale, and cottage industries. Curb the use of bank credit for speculative purposes like share market, etc. And coming to impact of nationalization, branch expansion to rural has been increased, farm credit increased, small scale industry credit increased, deposits increased, and credits to weaker sections also increased. Coming to private sector banks, we have Indian and in abroad. and also differentiated banks, which are small finance banks, payment banks, and wholesale and long-term finance banks. Now coming to small finance bank, these are scaled down versions of commercial banks. So basically small commercial banks these are, and they do basic banking activities like take deposits, give credit, and but only in a limited area. So the main focus for them are agriculture and MSMEs. Minimum paid up capital must be minimum paid up capital must be 100 crores. Coming to payment banks, the target is financial inclusion. They do this through widespread network of access points. They only give limited range of products. For example, they don't give any credit and deposits only less than 1 lakh. So they can give credit card, but they can give debit card, but no credit card. So the network is through bank branches, business correspondents or BCs, and network provided by the others. So the main target group for them are migrant workers and tiny businesses. Coming to wholesale and long-term finance banks, these have a minimum capital of 1,000 crores. They can't accept saving deposits. They can raise money through current accounts, bonds, and bulk fixed amounts. So the target is to relieve banking system, which have stressed assets in infra. They are much better at evaluating long-term projects. So why the need for them is to give them operational autonomy and also license based on ability to run such specialized banks. Coming to problems of commercial banks, these are the problems: branch expansion in rural, which are not profitable, and minimum infra not there in the rural areas. Also deposit mobilization, heavy competition among public sector banks which offer the same services, no coordination, therefore duplicate financing or over financing or under financing. Inadequate finance to agriculture, only less than 10% credit needs are met. Poor coverage of the rural, only 5% villages covered. Regional imbalance, more than 50% of the branches in south and west. And low profitability due to priority sector lending giving to rural and weaker sections. Low efficiency due to bureaucratic attitude and more SLR and CRR. Political interference due to in terms of poor staff selection and loans to undeserving. Liberal credit to agriculture and weaker sections led to low recovery rates. Now coming to scheduled banks, these are in the second schedule of RBI Act 1934. So they should have a minimum paid up capital and also satisfy RBI that their functions will be carried out in interest of the depositors. They can take loans from RBI at bank rate. Now NBFCs, what is an NBFC? It is a company registered under Companies Act 1956. They give loans and they acquire shares, stocks, bonds, debentures, and government securities, also other marketable securities. They do not do primary businesses such as agriculture, industry, services, or sale and purchase of goods. So that is an NBFC. Now, what is the difference between NBFC and banks? Both can lend and invest, but NBFC cannot accept demand deposits, but they can accept time deposits. They do not form the part of payment and settlement system, that is, they cannot issue checks drawn on itself. Also, no deposit insurance facilities there in NBFC. Now, three types of NBFC are NBFC D, NBFC ND, and residual NBFC. D, they accept public deposits, only time deposits. They can't accept demand deposits. ND, they do not accept public deposits. Residuary, they accept deposits and invest them in approved securities. Now, RBI recently, with respect to NBFC, they gave some NBFC norms, getting them in line with those of banks, like higher minimum capital, less time to declare bad loans, and a proper criteria to appoint the directors. So, how are NBFCs regulated? NBFCs, those registered with RBI, RBI will regulate them. Non-banking, non-financial companies, they will be regulated by the Ministry of Corporate Affairs, but enforcement will be done by the state governments. Other NBFCs, and they will be regulated by housing finance institutions by NHB, that is National Housing Banking, merchant banking, venture capitalist funds, and broking, collective investment schemes. They will be done by SEBI, basically related to shares and stock market. Nidhi companies and mutual benefit companies by MCA, that is Minister of Corporate Affairs. State funds by state government, insurance companies by IRDA. Nidhi company, this is a small topic. It comes under the Companies Act 2013. They lend money only between members. They're basically to cultivate habit of saving among the members. Recent chit fund scam calls for better regulation of Nidhi companies. Now, issues of NBFCs. The sector has evolved greatly, adding depth to the financial sector. So, since sector evolved, their operations increase, their products have become better, and tech is now better. RBI also done well to give regulatory response, has kept pace with this sector evolution. Now coming to regulatory regime for the NBFC, it's much lighter than banks. Therefore, bank credit to NBFC is increasing because they have much easier regulations. Therefore, what is the result? Risk of NBFC, which will be higher than those of banks, is transferred to banks. This is worrying. So steps should be taken to stop this. Also, size of NBFCs is 13% that of banks. Total banking sector size is 100 trillion rupees. So when coming to talking about systematic risk, if one of the individual NBFC fails, there won't be any systemic risk. But if all the NBFC fails together, there will be systematic risk. Also, NBFC bank linkages, like I have told here, they are increasing. Therefore, NBFC's risk is being transferred to the banks. Also, NBFCs are charging very high interest rates since RBI deregulated the interest rates, which was very complex actually. So NBFC, they need to be transparent. They disclose how they are arriving at the different rate of interest for different types of borrowers. So Usha Thorat committee, they gave some recommendations for NBFCs to increase the capital adequacy requirement. Now right now there is 15%, but there is no distinction between tier 1 and tier 2 capital. Tier 1 is the better capital, tier 2 is the inferior quality. They wants to make it 12% only, but everything should be tier 1 capital. Coming to liquidity ratio, it should be for 30 days. That is, to make the monthly debt payments, they should set aside the cash balance. Also, benefits must be given to them under SARFAESI Act, and NBFC with greater than 1,000 crore assets should be undergone through a and the stress test. And also, NBFCs should be subject to similar regulation those are banks, which RBI is doing now. Now coming to banking reforms, there are two committees basic which are most important. Narasimhan Committee 1 in 1991 during the backdrop of balance of payment crisis, and Narasimhan Committee 2 at 1998 as follow up to the Narasimhan Committee 1. So Committee 1, they gave the following reforms: to reduce CLR and SRR, therefore banks can lend more, and deregulate the interest rates, which was very complex. Deregulation is basically government won't tell how much interest rate to charge, and structural reorganization of the banks. 3 to 4 need to be big and international banks like SBI, and 8 to 10 national banks with a large national network to cover all the areas. Local banks to cater to local areas, and rural banks to cater to agriculture and allied activities, small scale industries, etc. And also establish an ARF tribunal to take over the doubtful debts, and these are basically NPS. Allow banks to raise capital. Profitable banks they can raise interest from capital market, which is share market, and the weak banks, the government should give them loans. Now, North Committee 2, they asked for a stronger banking system. Match two or three stronger banks. This will give the multiplier effect on the banking sector. Stricter norms for NPA. They basically said about narrow banking concept, which is weak banks should only go for short term and risk free loans, and autonomy should be given to public sector banks. Reduce government equity to 33% only, and also RBI should relinquish seats on the board. Capital adequacy norms, this is the most important recommendation. Government should raise the CAR so that banks can absorb more and more risk. The target was set for 10% by 2002. There will be a penalty if this is not met. Now, how did they implement? RBI raised the CAR, so this is good. The asset classification has been done, that is NPA, stressed, etc. We'll see this. And criteria for autonomous status was declared, and 17 PSBs were given in 1999. SARFAESI Act was passed, which is good. So all these were done, and those things that were not done were government equity to 33% was not done, greater professionalism was not done, independence of board was not done. During the 2000 financial crisis, Indian banking performed better than international banking. The credit mainly goes to the Narasimhan Committee recommendations, especially the CAR, that is capital adequacy. Now coming to NPAs. What are NPAs? These are loans on which principal or interest repayment is failed for 90 days. In terms of farm loans, if it is a short duration crop, 2 seasons. Long duration cap, it would be 1 season. So the categories of loans are standard asset on which payments are regular, special mention asset account, this is NPA, NPA on which there is 90 days delay, substandard asset if it has been NPA for more than 12 months, doubtful asset if it has been substandard asset for more than 12 months, loss asset is basically it will be considered uncollectible. These can be identified by RBI or bank or an external or internal auditor. Now how to reduce NPAs? Two times before giving loans and after declaring asset as an NPA. Before giving loans, first of all know about your who we are giving to loan to. So we need to address info asymmetry, information asymmetry with respect to info about the borrowers. For this, RBI has started CRILC, which is Central Repository on Information on Large Credits. Basically, all banks will put up the information about whom they are lending to, so that all banks can access through this thing. Now, caution treatment with respect to defaulters. Make the distinction who are willful defaulters and non-cooperative like Vijay Mallya, and who are the real defaulters due to circumstances beyond their control. Now, proper restructuring of loans must be done. RBI has given guidelines with respect to them, which is 5 by 25 norm. We will see later. And for long-term project loans, flexible structuring must be there, and periodic refinancing should be there. After declaring an asset as an NPA, RBI has talked about the corrective action plan, which is early identification of the NPA, timely restructuring to maintain the viability, and prompt steps to recover the unviable accounts. Now, revive viable entities through timely restructuring. This is already covered. Debt recovery tribunal and appellate tribunals to get the interest fastly. And legal provisions like banks can invoke SARFAESI Act and sell NPA to SCRRC, SCRRC securitization or restructuring companies. Basically, they will buy the bad loan and they will try to recover on their own. JLF is a joint lenders forum. All the borrowers together will come and they form this JLF. Then lenders can talk and reach a conclusion about the prompt corrective action plan. Use of Lok Adalats, because it is fast, it is inexpensive, and a mutually agreeable settlement can be come. Now, recent initiatives are Prompt Corrective Action Framework or PCA framework. It is given by RBI. These are restrictions on the banks if certain limits are reached. What are these restrictions? Halting branch expansion, stopping dividend payments, and special audits. What are the risk thresholds? Asset quality, profitability, and NPA limit. Now, Indradhanush plan is the 7-step strategy. It is an umbrella scheme for banking reforms. First one is about appointments. Separate chairman and managing director should be there. Therefore, infusing professionalism into the board members. Banks board bureau, this is a body of eminent professionals. They will do the following things. They will recommend selection of the heads. They will help banks develop the strategies. Also, they will advise about the consolidation. Coming to capitalization, infusing equity capital, but this should be done only after transparency is established, and distressing must be done. Distressing can be done through ARCs, which are asset reconstruction companies. 6 new debt recovery tribunals have been set up. CRILC, we already talked about this, addressing the information asymmetry. Empowerment, that is no interference in public sector banks, they should be given autonomy. Framework for accountability, use the key performance indicators like what is their recovery ratio, etc., to judge the functioning of PSB. Governance reforms like Gyan Sangam, this is a conclave where PSBs and financial institutions can participate. Now, coming to few other measures for securitization companies, basically they buy the bad loans and they sell them on their own. There must be transparency with respect to transaction between the SC and bank, so as to prevent collusion with promoters in buyback deals. And coming to the FBA cap has been increased for them. Initially it was 14%, now it's 74%. And for the banks, capacity building must be done. Therefore, Center for Advanced Financial Research and Learning, this has been established. Strategic debt restructuring must be there. That is, we should give lenders 51% equity control, but this should not be given directly. It will be given after CDR mechanism is filled. CDR is corporate debt restructuring, and company is unable to repay the debt, only then 51% equity control will be given to the lenders. They will restructure the board and do something or other to recover their loans. 5 by 25 loans you talked about. Restructure the long loans for 25 years, and also we can revise the rates or sell the assets at 5-year intervals. Banking Regulation Ordinance 2017, this must be researched upon. For borrowers, insolvency and bankruptcy code, there's a fixed timeline to resolve this, which is 180 days plus 90 days as a buffer. And IBBI, Insolvency and Bankruptcy Board of India, this is a new regulator for professionals and agencies dealing with insolvency and information utilities. And adjudicate through NCLT, for that is National Company Law Tribunal and Debtor Recovery Tribunal. This is given to these, they advocate for companies and limited liability entities, and these for individuals and unlimited liability partnership firms. Bad banks, basically they buy the NPS and dispose them off. They were very successful in Western Europe, but in India majority of the stakes will be with government, therefore have the same issues as PSBs, which are governance issues and capitalization issues. Now some other issues are exit policy is not there. That is, once infrastructure project is started, if the funding is not there and the interest rates are increasing, there is no proper exit policy. This needs to be done. Judicial delays with respect to Surface Act and DRT. Low recovery, example average recovery rate for SCR, RC, that is securitization companies and reconstruction companies, is only 31%. And NPA to ARC, giving NPA to ARCs, it is done to non-transparent auction. RBI recommended to make it transparent. Joint lending forum, banks have a very small share on this, therefore they don't do independent analysis, they just follow whatever the biggest shareholders is. Now coming to pricing of NPAs, assets are not realistically priced, but the people who invest in the SCRRC, they expect very high returns, so it will be unviable. Official data on NPA is questioned by many, therefore there is need for transparency, and trust deficit is also there here. Capital infusion without transparency will be useless, therefore first become transparent, then only infuse capital. Fundamental governance reforms must be there, therefore follow PGNI committee recommendations, research upon it. And decentralized decision making, that is government must give more powers to PSB boards, but give these powers only after professionalism is instilled. This was said by Raghuram Rajan. And Niti Aayog, they talked about government setting up ARC, that is asset restriction companies. They will clear the balance sheets of the banks, therefore solving the twin balance sheet problem. This was given in the economics survey. Now Finance Standing Committee of Parliament, they gave some recommendations, which is forensic audit, why restructured loans turn into bad loans. That is, when there is an NPA, they restructured it, why did they again turn into NPA, that must be audited. And reviving DFIs, which are development financial institutions, they will create a vibrant bond market. Name and shame the willful defaulters. Few terms here and there: white label ATM, shadow banks, core banking solutions, banking ombudsman. Surface Act 2002 is important. This is the full form for that, you can go through that. Banks can recover NPS without court interference, then that is through three alternate methods: securitization, asset reconstruction, and enforcement of security. DCIPs are domestically and systematically important banks. Example, only three are there: SBI, ICICI, and HDFC. These are too big to fail. They have huge customer base. So if these banks fail, the entire finance and monetary system of the country will fail. Exim Bank is Export and Import Bank of India. It is wholly owned by government. They extend line of credits to the enable buyers to import from India, and also on basis of the deferred credit is basically loan. And they also help overseas acquisitions. For example, if Tata wants to buy something in overseas, they will also give them a loan. PSL certificates are, every bank must lend a certain percentage of their loans to agriculture, etc. So if a bank lends more like 50%, they can sell the extra ones as PSL certificates, and banks who don't meet that, they can buy them. It's basically like carbon credit trading.